Happy Friday, everyone, and welcome back to Your Finance TV. And for his first appearance of 2024, we have Jay Pelosky with his musings. How are you, Jay? Well, Happy New Year.
Yeah, Happy New Year. I guess we can still say that. It's the 12th already, though. Wow. Yep. A good solid 2 weeks off and really pretty well disciplined. Didn't look at the markets, really didn't read my emails or texts. I did a little bit of looking at Twitter, but nothing big. And so it's exciting to come back somewhat refreshed and see what really hits you when you start getting back into it. So that's what this week was for us. We started off hot with a model portfolio update week. And that, of course, leads to lots of charts. Remember that we're macro first, but we also believe in looking at the technicals and trying to marry that fundamental and technical picture. And, a bunch of things jumped out at me looking at the charts. I think we go over well over 100 charts, right? All our holdings in our two model portfolios at TPW, all the potential inclusions, things we're thinking about, all the cross assets we look at, and then all the indices we look at. So it's well over 100 charts. And, I'd say four things really stuck out at me. The first was that the S&P, it was just classic how it gave a real head fake right at the end of its decline in the fall, in November, late October, November. It broke its 200-day support, right? Which a lot of people use as a signal. When it's below the 200-day, they're out. When it's above, they're in. So it broke its 200-day support, and then within 2 or 3 days, rocketed right back above, and then 9 weeks up in a row. So impressive reminder that this business is as much of an art as it is a science, right? So then the second, and I'll be a little bit more quick here. The second was how nicely the markets resolved the overbought condition that existed after 9 straight weeks up, right? We had a 3 to 5% pullback, very clean, no big worries, and then boom, right back to hitting new all-time highs. The third point would be that the leadership is really cyclical, which I think is very important for us from the macro point of view, right? If you look what's leading, tech is leading, semis are leading, semiconductors, home builders are leading, financials, et cetera. So it's a very clear breakout. It's a very clear breakout led by cyclical stocks, or cyclical sectors rather. And then fourth, it's a global breakout. Because one of the things when we look back at 23 is we realized that, hey, the US wasn't the only game in town. Latin America was the best performing region in the world. Japan and local currency outperformed the S&P. And so one of our key themes for this year, one of our 4 for 24 market surprises, was that we were going to have non-US leadership. And that's starting to happen as markets break out. So that was really some of the takeaways from the charts and looking at all the technicals. But I want to leave you with one, and your audience with one point that really struck me, and that was Nvidia. Okay, Nvidia is the poster child for the AI innovation age, right? It's up almost 400% from its low in October of 2022. And yet its valuation has collapsed from over 80 times earnings last summer to 26 times earnings today. And you have Bernstein and Associates calling it the cheapest AI play out there. And so I think it's really important to keep in mind that the leadership stock in the leadership sector is the cheapest it's been in 5 years. That is a very telling indicator. And that's one of the things that led us to the title, which you like to ask me about my titles. You didn't today, but We Got Legs is the title of this musings. And when I say we got legs, I look at something like Nvidia, the poster child for the AI age, the cheapest it's been in 5 years. That's pretty telling in my book.
Well, I was going to keep it a little bit of surprise with the title for your musings, but if anyone wants to actually go see the musings, they can go to Pelosky.com to sign up for them. But
they can indeed. Please do. We're welcoming community here at TBW.
But you mentioned at the start here, like your focus is on macro though, Jay. Like, so what about the macro? What are we seeing here? What surprises are jumping out there?
Well, this is another reason why when I was thinking about the title, We Got Legs really kind of resonated because not only are the technicals for risk for equities looking quite good, the fundamentals, the macro underpinning also looks quite good. Remember when we published our 24 outlook, which was way back in October? Surprise, surprise. And we laid out four macro surprises that we expected, four for 24, and four market surprises. So the macro surprises very quickly, lower inflation sooner, rising productivity, a return to macro stability, and then resolution of the debate between early cycle and late cycle, with the early cycle winning. So since October, the first two have definitely manifested, lower inflation and rising productivity. And so what's caught our eye over the last couple of weeks, and as we come back into the swing of things, is the growing pile of evidence to support the return to stability and, even more importantly, the early cycle resolution. So return to stability, right? Let's just think about the jobs number last week. Let's think about the CPI number yesterday. Let's think about the Fed. It's not anywhere near as chaotic and uncertain as it was a year ago, right? Didn't move the needle. Neither data point really moved the needle for any assets. And that suggests to us that that return to stability is starting to manifest. And then that return to stability can kind of provide the setup for the early cycle debate, because we've been through arguably the downturn and we're coming out on the other side. And what is the evidence for that? The evidence is the semiconductor cycle is starting to turn, driven by AI. The housing cycle starting to turn. Mortgage applications last month were up 10% year over year. Transport, even manufacturing, with new orders versus inventories at a new cycle high. So the ISM is still not above 50, which a lot of people look for, but the leading indicator for the ISM is at a new cycle high. And so we think there's a lot that can be construed from this idea that there's a growing pile of evidence for the early cycle debate to really start to manifest and to be seen as winning the debate, early cycle versus late.
All right, so let's do a little bit of a pivot though, because earnings season's kicking off next week, right? Like, what's the good news? What's the bad news with earnings?
Yeah, well, the good news, I go back to our good friend, Dr. Ed Yardeni, who's been in the business probably longer than me and you. And he made the point that the recession that counts for stocks is the earnings recession. And that recession occurred at the end of 22 and the early quarters of 2023. So it's over. And last quarter, we had the first positive year over year earnings growth that we've had since 2022. This quarter, we expect the same. The bar is quite low. Consensus 1% earnings growth for 2024 or for Q4 2023 year over year. So we expect that to be met and beat. More importantly, focusing forward as we try to do at TBW Advisory, looking out for the full year 2024 and 2025, FactSet suggests that the consensus is for double-digit earnings growth in both years. So here again is another support to this idea of we have legs. We've come out of all the chaos of COVID, inflation spike, Fed aggressiveness, etc., rate hikes. And now we're moving into this stability period where the early cycle economy is picking up. You have double-digit earnings growth for 2024 and 2025. Suggests to us, again, blue sky opportunities here as we move forward, and a marketplace, at least for risk, that we think is unlikely to have major drawdowns if in fact those consensus estimates for double-digit earnings growth this year and next come to fruition.
Okay, so let's wrap all this up then. I'm going to mention the title "We Got Legs." All I think about is ZZ Top, even though it's not the correct terminology of the song, title of the song. When you say we've got legs, or we got legs, wrap it all up for us. Like, give us a summary of the whole thing.
Yeah, just like ZZ Top, right? Three guys with a lot of noise. So don't worry, I'm with you with ZZ Top, man. We got legs. So yeah, let's summarize, right? Risk assets breaking out to new all-time highs. So there's no overhead resistance. We finally are clearing the overhead resistance that has been in place for several years. Leadership is cyclical, so suggesting the stock market at least thinks we're early cycle. The AI poster child, the stock that's the poster child for the AI revolution, is the cheapest it's been in 5 years. The breakouts are increasingly global. So those are really the four factors that we see summing up the case for we got legs from the market perspective. From the macro perspective, we have again double-digit earnings growth, right? We have a floor being put under the China real estate problem. One of the things we note in the musings is that Bloomberg's China junk bond index has actually been up 5 months in a row. And that is mostly property developer names in that index, up 5 months in a row. It's got to be one of the best kept secrets in the world because everybody hates China. Everybody hates China assets. And so the property sector, that's the epicenter of the risk in China, looks like it's starting to heal. So there's another macro support. And so we look at the micro, we look at the macro, we look at markets, we look at all these different factors. And to us, there's an awful lot that suggests that we could be entering that return to stability in a couple of years of some pretty decent upside. Now, that's not to say we're not going to have bumps, we're not going to have pullbacks, et cetera. But for investors, I think a key thing to kind of consider is that we're moving away from the last couple of years of uncertainty and chaos, of aggressive policy action. And we're starting to now stabilize and move into a world that could be quite constructive for risk asset returns. And I'll just leave you with this one data point. The consensus for the S&P at the end of 2024 is 4830. So certainly the idea of blue sky ahead is not consensus. And that's also a place where we like to be here at TPW Advisory.
All right, one last question for me before we sign off. Taiwan elections this weekend. What are you thinking on that one?
Yeah, it's funny you mention that because we do touch on geopolitics as seemingly the bastion of risk, right? Everyone wants to talk about elections in the U.S., Taiwan elections, Middle East conflict, Ukraine conflict. They obviously haven't heard from the guys at Clock Tower, Marco and his group, who have made plenty of studies demonstrating to us, at least convincingly, that geopolitics really do not move risk asset markets for very long. So, we don't expect any radical shift in Taiwanese politics. We don't expect any dramatic shift in China's view towards Taiwan. China's got plenty of challenges dealing with the domestic economy. That's job number one in China right now. And so, we're big believers in fading geopolitical risk and actually see it as kind of a backhand compliment to our return to stability surprise, right? If we reduce to worrying about elections all around the world, that's a much better thing to worry about than, job losses and rising unemployment or spiking inflation or a Fed that's radically changing the interest rate dynamic. That's what we've dealt with over the last 3 years. That's now in the past. Let plenty of people talk about geopolitics. That is noise to financial markets. Double-digit earnings growth for the next 2 years, the poster child for the new innovation cycle, the cheapest it's been in 5 years. That's what investors should be focusing on.
All right, Jay. Well, listen, thank you very much for that insight and for all of your insights. Have a great long weekend because the markets are closed on Monday. Enjoy the NFL playoffs sitting in the armchair, and we'll talk to you again next week.
Did you get my calendar for this weekend?
I did not.
Well, that's it. Sitting in the easy chair watching football. That's pretty much going to be it for me. And hopefully you do the same and continue your getting better from your little wheel injury there.
Nearly there, mate. Give us a few more weeks and I reckon I'll be running around. All right,
Awesome.
everyone. Thank you very much for viewing. And until next time, good luck investing.